Here's a case study of a young lady who has a full FERS annuity at retirement of $2,686. Her goal was to leave her spouse 50% of her FERS annuity pension. Her spouse, too, was a federal employee who was retiring actually in this particular year. Okay? So their health insurance was under him. It was never under her. She could elect to choose the FERS surviving spouse benefit, which will cost her 10%, as you see the SSB cost there, $269 per month. Okay? Her pension will be reduced from $2,686 to $2,417 per month. Because again, that $269 monthly premium is being paid to secure her spouse 50% of her pension, which is $1,343 there, as you see SS benefit gross. Now that benefit to her husband is taxed. Okay, we don't know what tax bracket they're in, so we just take a 20%. So we're saying here net 80%. So if the $1,343 gross surviving spouse benefit, he could expect to receive approximately net $1,074. However, again, she doesn't need a health insurance, right? But she wants to leave this benefit. So the retirement specialist came up with a more viable option for her. And that is to use what's called a pension max. Okay? A pension max is a uniquely structured life insurance strategy that will provide your surviving spouse a portion of your pension, whatever that amount is. That could be 5% up to 100%, whatever amount it is. But in this case, we chose the 50 as she wanted to leave. Now, that's a $101.07 savings. Again, this benefit worked for her because she did not need the federal employee health benefit coverage. Some of you all would use Tricare, so you too would not need the federal employee health benefit coverage. Some of you all may want to do a hybrid between the FERS surviving spouse benefit plan versus the pension max. And these are the reasons why. Because his monthly income just increased $1,434 a month, and it's all tax-free. That's a $359.60 increase in his income. This, again, is a uniquely structured life insurance strategy. I know many companies try to piecemeal permanent policies, and they like to use universal life and whole life and a company term on top of that to make this work. I personally like to keep things simplistic so the client knows how it works, but we also know unequivocally how it works. Okay? Over a 10-year period, if she keeps the FERS government option, over a 10-year period paying that $269 a month, she would have paid $37,345. Over a 20-year period, she would have paid in $81,229. Okay? Now, if she passes away anytime in year 10, 15, or 20 under the FERS surviving spouse benefit, her husband would only be entitled to receive the monthly benefit, which we have here net of $1,074 a month. Okay? So it does exactly what she wanted it to do in the event she predeceased him, right? However, if he predeceased her, let's say going into year 20, the $81,229 that she's paid in, she can't recoup that. That money is just paid. And people always say, well, why would I elect it? Because you may need your spouse to be covered under your federal employee health benefit coverage, or your goal may simply be, like my father's, to leave a surviving spouse benefit to your spouse, right? Now, if he predeceased her, they're going to stop deducting this $269 per month. She cannot recoup any of that cash. It's zero. They're only going to stop deducting the $269. All right. Now, with the pension max option that she have gotten through our retirement specialist, projected to pay $40,300 over 20 years. That's literally half of what she would have paid under the first system, right? If he predeceased her, it's a big difference now. Of the $40,300 that she's paid in year 20, she could surrender the policy because she no longer needs it because it was purchased solely for his surviving spouse benefit, and she would receive $30,963 in a direct deposit into whatever account she designates. If she predeceased him, however, still works the way she wants it to, right? He's going to get $1,434 net, which is still $359.60 increase of income for what he would have received under the first benefit. Or he could take the lump sum payment, which in year 20 is $155,503, right? So that gives them both choices. They both have choices at that point. Therefore, it only makes sense for her to choose the pension maximization strategy because it gave them the maximum income in the event of a premature death, but also gave her a return on her premiums if he predeceased her